So good afternoon and welcome back. We've had a couple months here. We took a little break, summer vacations. You got to have them, but we're excited to be back into the groove with our Affordable Friday series again. And I wish you all good afternoon and a happy Affordable Friday. So, on behalf of the New York Mortgage Bankers Association, our newly minted president Sherry Eccles, our entire board, and our affordable housing chairs, which also includes Sherry and myself. I thank you for joining today's webinar with our partners at National Community Stabilization Trust, or NCST. Before we get started, just a few quick housekeeping notes. If you experience any technical difficulties, please use the chat box to notify us. During today's webinar, all lines are muted except for our presenters. There will be an opportunity to ask questions. Please use the chat box to ask questions, and we'll do our best to address as many as we can during the Q&A session at the end. We will be sharing the presentation slides and relevant resources with you after the webinar, so stay in touch with us on that. We also urge all mortgage professionals, just do it, to join the National MBA's Mortgage Action Alliance. All you have to do is just put it in the search bar on the internet, Mortgage Action Alliance MBA, sign up for it. It's an easy, free way to stay informed on legislative issues that impact you, that impact the way you do your business and the whole real estate lending ecosystem. So don't skip over that one. So with us today, I'm super excited. We have Sarah Edelman and Carlos Alcazar. And I'll start with Carlos. He's the Chief Operating Officer of NCST. He joined NCST in 2010 and has more than 24 years of experience in mortgage banking with direct management in originations, production, operations, and community lending. Prior to joining NCST, Carlos was Senior Vice President, Director of Special Programs at City Mortgage, where he led their mortgage revenue bond programs origination through state and local housing finance agencies, along with specialized programs including the California Public Employees Retirement System, CalPERS, and the Texas Veterans Land Board, TVLB. So during his tenure at City Mortgage, the department finished ahead of plan and originated more than $2 billion in loans amid economic turmoil. Carlos earned an MBA from Keller Graduate School of Management and a BA in Political Science from Arizona State University. Sarah Edelman, she is the Vice President for Policy and Programs at the National Community Stabilization Trust. Prior to NCST, Sarah served as Deputy Assistant Secretary at the U.S. Department of Housing and Urban Development, where she led the Federal Housing Administration's single-family mortgage program. She also worked at Fannie Mae, where she launched and managed the Duty to Serve program. I'm sure you're all familiar with that. And the Center for American Progress, where she led housing research and advocacy. Sarah started her career in local community development, and she holds a bachelor's degree in history from George Washington University and a master's degree in public management from the University of Maryland. And I'm super happy to have both of you. And with that, I'll kick it over to Sarah. She's going to start off with her presentation today.
Great.
Thank
Thanks
you.
so much. It's we're very happy to be here for your fall kickoff of Affordable Fridays. Though I can't see your faces, this is always such a fun and engaging group. So really looking forward to the conversation. What we're going to do here, like many of you, we are very focused on housing supply. As Brian mentioned, prior to this role, I led FHA's single family mortgage program. And this transition to focusing on supply has felt right because you can have all of the mortgage flexibility you want, but if there aren't homes to buy, home buyers are in a pinch. So we're going to focus on, so what we're going to do today with our time here, Carlos is going to walk you through through basically who we are and both the programs we offer to support housing supply. He's going to talk through some of our transactional platforms and also an interesting fund that our CDFI launched to bring capital into disinvested neighborhoods. Then we're going to pivot over to me, and I'm going to walk you through a super interesting bipartisan housing supply solution that we've been working on with others, including the National MBA, called the Neighborhood Homes Investment Act. And I'm going to walk you through what it is and how it works, because I think it'll be very useful for some of the neighborhoods that you serve. So thanks for your time. Really looking forward to the engagement part of this. And Carlos, I'll kick it to you.
Great. Thank you so much, Sarah. Brian, thank you so much for having us. And I'm really excited to talk about NCST. Yes, we were National Community Stabilization Trust. We rebranded, we shortened our name because that's just too long for us to say. So we are now NCST. We're trying to get that going. Just similar to what you see on your screen, the Local Initiative Support Corporation is LISC. That's how everybody knows them, as LISC. That's what we're trying to do. But let me give you a little bit of background about NCST. So we are a national nonprofit. We were born of the financial crisis in 2008. We were created to be an intermediary between the financial institutions that had REO property and the community development organizations on the ground, nonprofits who were into acquisition rehab, government entities, and in some cases, for-profits who are doing mission-minded work in communities. So we were established by 6 of the largest nonprofits in the United States, as you can see on the screen. They all still work with us. We all partner with them in many capacities outside of them, starting NCST. And so over the last 17 years, we've facilitated the transfer of over 28,000 properties throughout the country. So we, as I said, we are national. We've worked in pretty much all the states, with the exception of Alaska and Hawaii. Not a lot going on during the financial crisis that really fit our model from that perspective. But we did create an exclusive First Look program that I'll go into in a little bit later here. But the next screen that I've got up, kind of wanted to give you, a little closer, actually a little more closer look at what NCST does from a mission perspective. So I'm not one to read slides, so I think everybody can read what's on our screen, as far as what our mission is. But we've had some changes over the last 17 years from at the top level. Our most recent change was in 2022 when our former president, Julia Gordon, who became the FHA commissioner, we went on a search to identify a new president. And so in July of 2022, we hired Christopher J. Tyson, former LSU law professor, former head of the Baton Rouge Redevelopment Authority. He's located in Baton Rouge, and he became NCST's 4th president. And through that change, we decided to obviously, embark on a multi-year strategic plan. And so during that plan, we identified 3 pillars that NCST would be working on starting in 2022. Number 1, transactional practice. Number 2, policy practice. And then number 3, community development. On the transactional side, I'm going to talk a little bit more on the REO Match platform, REO Track, and then the First Look program itself. From a policy perspective, which is where Sarah kind of resides in, she's going to talk about NIA. But we also do other items under the policy practice. We have the Homeownership Alliance, which is a practitioner-led group, which we're trying to advocate for better policies for single-family affordable homeownership opportunities. And then our community development kind of captures everything else that we've been working on. We lead the Middle Neighborhoods Coalition. We also just launched a new Black and Latino Middle Neighborhoods heirs property program. This year, we're working in 3 markets: Baltimore, Atlanta, and Birmingham, Alabama. So we're just finishing up that first year of the program. And next year, we will still be in those 3 markets, but we're also expanding into 5 additional markets. And then down there, we've got Dash. So that's our lending platform. And I'll talk a little bit more about that on the next few slides. So Sarah,
And just real quick, just to let folks know, we were just joined by our colleague Raquel Reddy, who is our VP for Community Development and also leads all of our CDFI work. So Raquel, really glad you could be with us here.
Thanks, and apologies for being a little late.
That's okay. All right, Sarah, thank you. So this is the work that we've done under our transactional pillar, right? So First Look is a program that we developed back in 2008. I'll call this our flagship program. So this is where we were taking, again, the REO from the financial institutions, putting it into REO Match, which I'll show you in a second, and then kind of filtering it down to nonprofits who would be able to acquire and rehab those properties and put them back into productive use. So really, that's the program we've always operated under. We still operate it today. despite the lack of REO, even though it's still out there, it's not, obviously at the numbers that they were back during the financial crisis. We've also ran a donation program through a couple of the banks, so Wells Fargo, Bank of America, Mr. Cooper, and then the Community Restoration Corporation. So that's obviously, it is what it is. These are programs that were donated to our community buyers. In some cases, they came with some subsidy to be able to do additional work on those properties, either demo in some cases or provide some assistance with the rehab. Some newer initiatives that we've started. Actually, yeah, there you go. Thanks, Sarah. Freddie Mac Early Access, we started a few years ago. Those are Freddie Mac properties that are getting ready to go into the auction space, but we get access to them to be able to have our community buyers take a look and see if it's something that's going to interest them. Now, a lot of these properties are a little more distressed than the typical REO, so they have a little bit more of a discount. The HUD CWCOT properties is something that was launched back in 2022, August specifically, where FHA created a first look CWCOT program. That since has changed. The first look program was essentially eliminated in May. And then we also have additional inventory providers. So we look sometimes to our rental organizations that are specifically acquiring properties, but for rental purposes, where they're now at a stage where they may be disposing of some of those assets. So we're trying to help them dispose of those in communities that are still kind of recovering from the crisis. So Sarah,
and just as I'm switching real quick, just a quick plug. We have a ton of community buyers in New York State. And so as you're sort of listening and, if you're thinking if you ever want to partner, we have just a great, just a wealth of resources in New York.
Thanks for saying that, Sarah, because I was curious to see what the level of inventory that we've had, or not even the inventory, just the activity that we've had in New York since inception. Mm-hmm. So we've actually closed roughly almost 700 properties over the last 17 years. We've had 77 buyers in the state of New York live at one point. Currently, we do have 18 that are still actively purchasing properties when they come into the market, right? Again, the inventory is very limited, but we still are currently working with some active buyers. And obviously we can talk a little more about that. But, as far as the first look program and really what does that look like, it operates under a net present value, which is kind of something that we wanted to make sure that didn't impact our financial institutions. So the program fits nicely from the time that the property gets reverted back to the servicer, and then by the time they go to market. And so what we wanted to do is create a net present value model where from the time that we're able to list that property, at least on our platform, they're not paying, there's savings on those items that are on the screen: maintenance, insurance, admin, and other marketing costs. So that's a cost avoidance model that we created. And so those savings then are passed down to our community buyers, which is really nice, obviously, because they're buying a property at a discount, and then they'll be able to kind of put whatever level of rehab they need to put in that particular property. But that's something that really has worked, traditionally has worked very well for us. The discounts have been, in some markets, have been pretty good. Other markets, not so good. But in either case, our properties are being sold at a discount to our community buyers. So Sarah, if you want to move to the next one. Okay, so I wanted to double click a little on the CWCOT program. Again, it's an FHA property. It's a different kind of transaction for us. Normally, and I've got a slide of kind of the flow of how everything works. Normally, we get the property, they get to decide what they want to do with it. They get more information from the community, from the financial institution, and then we transact on that particular property. The CWCT properties are actually flowing through the auction platforms. And so we needed to go and work with, the auction platforms in order to be able to provide access to these particular properties for our community buyers. And so we're currently working with Zome, we're working with Hubzu, and we're working with ServiceLink on those particular properties. Now, as I mentioned before, the first look opportunity has gone away. So it's open now to everybody, but you still have to be a HUD approved nonprofit or government entity or owner occupant to be able to purchase those particular properties. They're challenging. I will say this: CWC properties are very challenging because you can't inspect them. There's no contingencies. A lot of these are owner occupied. So a lot of our nonprofit buyers are not, they don't feel comfortable in purchasing properties that are occupied, obviously, because there could be tenants involved. And in some cases, the holding costs while you remove the tenant can be very long, and it just adds to the rehab cost. And so it just doesn't make the deal pencil out. And so they can be very challenging. We've transacted certainly on them, but we're still trying to obviously encourage FHA to make some changes that might be able to make this program slightly better. All right. You want to go to the next one, Sarah? Okay. So here's a screenshot of REO Match. This is our bread and butter platform. It's a web-based interface that if you are a community buyer that purchases properties through NCST, you would have access to this platform. And essentially what it does is you identify your target areas, right? This is a example. This is in Los Angeles. So this particular buyer is working in the areas where you see those shape files. We call them polygons. So they literally, you can work down to the census tract level, and that's where you want to work. If you want to look at more of the MSA level, you can certainly map that out. But anytime a property is received from our financial partner, we geocode it, and then it gets dropped into your REO Match platform. And that way you'll be able to identify everything that's going on. It's a history of every single property that you've seen, that you've transacted on, that you've passed on, that you've closed on. And so it's a great tool for us. It's been amazing work. It's very easy usage from our community buyers. We also use this as a part of the Neighborhood Homes Investment Act mapping system. So it provides a lot of other opportunities for NCST to be able to use that platform. But we can certainly provide a demo if people want to see it live in action. But this is a screenshot, and I think this provides a very nice kind of overlook of the REO Match platform. Okay, so here's the timelines I was talking about. It's a very fast process. And I think that was the key point that we wanted to ensure our financial institution partners was we don't want to disrupt your property by the time it reverts back to you from the time that you want to go ahead and market it. So we wanted to do something that was very quick. From the time that we drop a property, at least this is on the first look at the top one, from the time we drop a property into REO Match, that community buyer has literally 24 hours to decide whether they're interested or not. And so if they don't, say that they're interested, it'll go back to the seller. If they say that they're interested, then it goes through the next process, obviously, right? So after they do express interest, you get about 2 to 4 days to inspect the property. Sometimes it can be quicker. Sometimes it could be delayed, if there's lockbox codes or anything like that, or maybe the trash out has not occurred yet on that particular property. But nevertheless, we're always trying to make our community buyers move as quickly as possible. So by the 5th day of wanting to, express interest in the property to inspecting it, and you're fully interested, you can now request pricing on that particular property. So after that, the seller will send you the pricing using that net present value, and then the buyer has 24 hours to respond. So again, very quickly, you got about 6 days from the time you get to see the property in REO Match to the time you say, I want to buy this thing. And then it's traditional closing. We provide all the purchase agreements. They're uniform. We obviously facilitate the closing, and it's usually typically 30 days. So it's very quick. So that's the first look. The other ones tend to be a little bit longer because it's a different type of process. The Neighborhood Stabilization Initiative was something that was created in partnership with FHFA, working directly with the GSEs, so Fannie and Freddie. We started out in 18 markets, and then we increased that to over 25 markets. We currently only work with Freddie Mac. We are not working with Fannie Mae at the time, but are looking forward to re-engaging them in the future. And then the second look is sometimes we have a property that goes through our platform, our buyer is not interested. However, the seller is not able to sell it, so they'll send it back to us, sometimes with bigger discounts. So it's just a different process, not as quick, not as time sensitive as the first look, because they're already holding on to it. They're already paying, the seller's already paying those costs. So, that's, we don't need to move quickly on that. And then the Freddie Mac early process, that's again, pre-auction, little, doesn't have to be as quickly as first look properties. All right. So all of our properties go through the REO Match platform, right? And then our community buyers will go ahead and transact or purchase those properties. So once they purchase those properties, it's closed and it's in their possession, we require some reporting on the back end. So this is through our REO Track platform. So what the buyer needs to provide to us is a scope of work upfront, pre-rehab pictures, and then on a quarterly basis, they need to provide us updates on how the project is going. So any changes in work, post-rehab pictures and whatnot. But when it's completed and it's sold, ideally, we want to find out who that home buyer is. If it went to a first-time home buyer, repeat home buyer, buyer between below 120% of AMI. We're trying to collect that data. It's a very unique data set. It's something that nobody else is capturing. So we really have all the transactional information on the 28,000 properties that we've done over the last 17 years. So from the time the acquisition price, the rehab costs, and the resale price on the back end. It's something that we're very proud of. It's been used for research projects. It's been used for an Emory paper to identify the spillover effect that these types of programs have. This was specifically in Flint, Michigan. We also have a paper of how important first look programs are in the state of Florida. And then this data has actually been analyzed at NYU under the, I have to look up, it's Center for Urban Science and Progress specifically. So these are data scientists. They've been identifying and looking at that data. We've asked for cleanup. We've asked for an analysis of it. We've actually got a project that's been submitted and we're waiting to hear back that I'm very excited about, and hopefully it gets chosen, where we're going to try to look at a specific county and look at their vacancy issue and try to identify what the cost of that vacancy would be to rehab using our data, obviously, including, inflation, rates in there. So, but it's something that I think is very important for us to identify. There's a lot of vacancies out there right now, and I think that's one of the solutions that we want to, obviously use to fix this housing crisis that we're in. All right. So let me quickly switch to, and I'm keeping an eye on time, our developing affordable starter homes. So as you all know, you're in an industry that is full of acronyms. So this is DASH. This is our DASH program. So we launched this back in 2022 or 2021 with two purposes. Number one, to be able to support a group of BIPOC developers, specifically in the city of Baltimore, who aren't able to gain access to capital from the financial institutions. And so we're providing low-cost capital for them to acquire and rehab properties, again, solely right now in the city of Baltimore. The second reason why we started that, you can keep that one up, that's fine, Sarah. The second reason why we started is we wanted to use that lending activity and lending history to be able to apply to become a CDFI. So in October of last year, we were notified that we were approved as a CDFI. We made it official this year in January. So now Dash is a CDFI that is able to obviously continue lending in the city of Baltimore, but we're trying to expand in other markets. And, we are looking at markets like Memphis, we're looking at Tulsa, we're looking at Philadelphia. And just recently, we had a conversation with an organization up in upstate New York, Albion to be specific. There's an opportunity for a Dash-like program there because there is a need for small developers to have access to, good capital to be able to acquire and resell homes. And just quickly on the next slide, it's a public-private partnership, and I think this is the way we want to do it in all the markets. NCST is the sponsor. Our capital partners are the Baltimore Community Development, Department of Housing and Community Development. They provide the loss reserve. And the Neighborhood Impact Investment Fund is a local CDFI. They provide the main source of capital. NCST put some money in, as did the Aquia Fund, which is a local developer. And then we've got right now, since we just are a new CDFI and trying to identify how to bring everything in-house, we do have an operating partner, the Dominion Group, they are a local organization in the city of Baltimore that helps us do all the underwriting, all the servicing. They're extremely knowledgeable of the market, which is part of the reason why we chose them. And then Sarah, really quickly on the next one. So again, as I mentioned, we're just in Baltimore right now. Our capital is restricted to the city of Baltimore, but this is, these are the areas and this is who we're lending to. So we're doing single family 1 to 4 units. We're not doing commercial. We are doing, again, small developers. So requires a personal guarantee. We're not doing condos. Our second iteration of this Dash Fund, whether it be in Baltimore or in the other markets that I mentioned, is we want to be able to lend to nonprofits. Nonprofits also need access to capital that is, competitive for sure. And we also are looking at creating additional products like a line of credit, so they're able to go ahead and fund projects a lot faster than a one-to-one. And then just some quick eligibility on the next slide. Again, City of Baltimore. Again, these are basic. There's still other requirements that we need, but at least a minimum 600 credit score, and then having at least have done 3 construction projects over the last 36 months. I will say that in the loans that we've done over the last 4 years, our average FICO score is above 700. So FICO is not an issue. Capital is not an issue. Again, it's the ability for these developers to walk into a bank and get access to capital, competitive capital, or anything at that point. So we just want to make sure to step in and provide that for them. And then finally, I just wanted to show you some quick pictures of some of the projects that we've done. I think Sarah might be in the next one. Yes. Okay, there's one. So if y'all aren't familiar with the typology of Baltimore, there's a lot of row homes, and there's a lot of row homes that are in this kind of state. There's a lot of vacancies. There's close to 13,000 vacant properties in the city of Baltimore. And a lot of these some of them are in decent shape, but this one was a complete gut rehab. And you'll see the next slide will show you what happened to it. Amazing work by our developer. And this was featured in a local news station. The work that this developer did was absolutely amazing, and it transforms the block, right? Once you get one going and you get another developer doing some additional work, it really starts to kind of revitalize the neighborhood. And then just one more really quickly, Sarah.
Yeah, sorry, my computer's getting.
No, that's okay. Yeah. All right. So again, this one, the middle picture is the basement. So again, your typical, it's in decent shape, you would say, but obviously needed some work. And then the result was the following page.
Go.
It's Friday. It typically happens. Okay,
Yeah.
so there you are, right? People have commented on the choice of colors. I think it's okay. It pops, right? But nevertheless, this is the kind of work that our developers are doing in the city of Baltimore. And we know that once we, replicate this program in the other markets, we're going to see the same type of level of rehab in these types of properties. So I'll stop there and hand it over to.
Thanks so much. Yeah, thank you so much, Carlos. Brian, this would be a good time if there are any questions before I pivot to the policy stuff. This would probably be a good time to pause, and any questions about this program or just the, the first look REO match program.
Yeah, no, this is fantastic. It's a very interesting. So Dash, how is Dash funded? Is that as a CDFI? If you could shed some color on that, be great.
Yeah, absolutely. So on the one side ahead, so the Neighborhood Impact Investment Fund is a CDFI, so we get capital from them from that perspective. But one of the main ways that you can get funding is through the CDFI fund. You can apply for capital that way. The other way is obviously going to our bank partners to be able to fund the CDFI. It's challenging, I will say, because we're considered an emerging CDFI.
Mhm.
You have to have certain requirements. Since we're so new, we don't necessarily meet those requirements. So we're looking at a lot of philanthropic support. There's a lot of philanthropies throughout the country that are supporting the local CDFIs. CDFIs fill that gap that the banks can't fill, right?
Right.
There's about 1,600 CDFIs throughout the country, and we're doing work like this kind of stuff. They're doing micro lending, they're doing mortgage lending to consumers that may not be able to get into, normal mortgage products. They're doing commercial, they're just doing all kinds of stuff. But yeah, those are kind of the same ways, some of the ways that you can get funding for being a CDFI.
Yeah, and that CDFI designation really opens a door for financial institutions to donate, whether it be a grant or whatever, and receive CRA credit for it.
Absolutely. Correct.
So
Yep.
yeah, that's fantastic. So I just wanted to circle back on one quick thing. With REO Match, you have all at the end of the waterfall progression, you have the community buyer.
Yes.
Um, and the ultimate occupant or whoever that is, you really want to know who that is, and you do. You find out, a number of different data points on that. If you could just outline a common or a more probable, the most probable scenario, how does that end buyer get funding? Is that through regular mortgage origination outlets that we're all familiar with, or is there some other mechanism in place?
No, that's a great question, Brian. So our program, our intended outcome for all of our properties is homeownership.
Mhm.
That's what we want to be at the end of the day. Occasionally, if there is a issue selling the property, we will allow for rental as long as it's affordable rental, right? And we also
Right.
keep track of that. But yeah, these home buyers are using just traditional mortgage lending. In some markets, if there's down payment assistance available, they'll work with down payment assistance providers. Some of our buyers, I will highlight a buyer in the city of Detroit. They acquire and rehab properties, but they're also a home counseling agency, and they also manage the city's down payment assistance program. So
Right.
they're able to, they've got a buy, they've got a list of buyers that are ready to purchase properties, and so they're able to do that. And a lot of our community buyers operate that way, where they've
Mhm.
got a pipeline because they can get down payment assistance from providers throughout within that particular market.
Excellent. Through that mechanism, are you able to handle or deal with effectively the gap, the equity gap that exists in some of the target neighborhoods, target census tracts, where the as completed value post renovation um, is higher than, or the as completed, the cost of completion, I should say
Right.
it that way. The cost of completion is higher than the as completed value.
Ryan,
Right.
that's
Right.
like the
Thereby,
perfect segue to
I'm
Exactly.
my part of the
I'm setting you up,
presentation.
I
silver
know
spoon.
that's
But yeah,
beautiful.
that's a huge deal, right?
It is.
That's why that exists in
That's
perpetuity almost.
that's
So,
correct. Yep. Yeah. I will say, in the work that we've done in Baltimore, we've not seen that yet. Right. So
mhm,
the work that they've been able to, the level of rehab on these properties, they've been able to resell at a higher value. Historically, in the NCST, kind of the first look program, I would say, in some cases, in some markets, maybe. However, the money that was being used was NSP money.
mhm,
So it wasn't necessarily that provider's capital. So they were not as strict to take a loss on the property, if that makes sense, right? Because
yeah,
it's not, I hate to say that it's not their money, but they were able to do that. But I think for the most part, we haven't seen that. I think, but it depends on the market, right? And
mhm.
but Sarah's going to talk more about how we're going to fix that problem.
Yeah,
Great.
before I jump into that, Raquel, anything you want to add or share that we didn't cover? Oh, you're on mute.
Just really quickly, it was to add to something that Carlos was saying, and for Brian and everyone else's benefit, is that when we do go into markets with Dash, we are trying to keep those price points at a cap that
Mhm.
makes it affordable. So in Baltimore, that caps 350,000. We found that the resale of the properties that were rehabilitated through Dash were roughly about 225. Correct me if
Mhm.
I'm off on that, Carlos. And
Maybe.
so really trying to remain in that affordability price point is important for our work as well when you look at what we're doing with Dash and the distress inventory in cities like Baltimore.
Mhm.
Thank you for
Excellent.
that. Brian, I'm going to pivot now to the policy piece, but please feel free to jump in if you or others have questions. I can't see the chats, so just
Fair enough.
feel free
We're
to
we're
stop
clean right
me.
now. Anybody have
Okay,
questions, please submit them through the chat. Thank you.
let me make sure okay, here we go. Hopefully the slides cooperate. Um, so I am going to hit on really on Brian, you teed it up perfectly. There are a lot of markets in the country where it costs more to construct a home or rehab it than you can sell it for. And so this proposal, the Neighborhood Homes Investment Act, it is a bipartisan bill that would really pump funds into filling this gap. So you can read the slides yourselves, but there's strong bipartisan support, and I listed out the members from New York who are already on it. So I'm going to go through sort of the what, where, how, who of the Neighborhood Homes Investment Act. So first, sort of what is it? This is a federal tax credit that is based on your overall population, and then it's handed down to the state. So it's kind of like LIHTC in that way. The governor chooses the allocating agency. Typically, it'll be the Housing Finance Agency. So your HFA would get this chunk of money and they would put out their qualified allocation plan, which is sort of their guide to how they want to target these funds, how they're going to be assessing the proposals that come in, and then eventually they will reward the credits. They will, they will make allocations to, it could be developer, investor, lender, to use these credits. And then the sponsors who are selected have 5 years to raise the additional equity they need and to deploy the credits. You can use this for all sorts of, I've been saying single family, but as a shorthand, but it can also be, as you know, that includes 1 to 4 units. Also could be condos or co-ops, includes MH. And most importantly, from my perspective, this covers new construction. It covers acquisition and rehab of properties, and it also covers owner occupants who want to rehab their homes. All right, so now moving on to sort of the what areas are eligible for these credits. And so this program is targeted at distressed areas. So about 60% of the HFA allocates about 60% of the credits to neighborhoods that meet this distressed criteria. So that's higher poverty, lower home values, lower income. The HFA, though, that has some flexibility with the other 40% to go rural, to go to other areas that it may even be higher income, but that the HFA determines have a real shortage of affordable single family housing. And I'll just pull up one map to illustrate this. But you can go to neighborhoodhomes.com and look at our interactive map and kind of play around with where you live to see what the qualifying areas would potentially be. So here we've got Buffalo, both sort of the downtown core and then also the surrounding areas. Dark blue are the areas that meet that distressed category. So those are the higher poverty, lower income, lower home values. And then if you look sort of in the broader MSA, the sort of crisscross light blue, those are qualifying rural areas. All right, so now going into to how sort of the guts of how this works. So I'm going to walk you through some of the criteria and then a couple of examples. So for new construction or substantial rehab, the developer can claim up to 40% of the development costs. So it's either the lower of 40% of the development costs, or, and I will really try not to break your brain on a Friday with so many technical details. I don't know why 32% was selected, but 40% of your development costs or 32% of the national median home sales price. So in this case, it would be 40% of your development costs up to $134,000. Important to note that you can't actually exceed the gap of how much it costs you to develop and know what you can sell it for. So a couple of examples. This is an example. So the total development cost, $320,000 between land, construction, developer fees, etc. Sold it for $260,000. That gap is $60,000. The maximum that a developer theoretically could claim would be 40% of those development costs. So, 40% of 320, 128. Since the gap was only 60, they're going to get 60 on this one. Switching gears a little bit, here's how it works in the owner-occupied scenario. So say a homeowner wants to do some rehab on their home. Basically, the way that the Neighborhood Homes Investment Act works for owner-occupants, they can get 50% of their costs covered. It's capped at $50,000, and these have to be meaty enough rehab efforts that they're spending at least $25,000. So here's how it would work. Somebody puts in $60,000, they get $30,000 of that covered by this tax credit, and then they need to bring that other $30,000, so that other half, either they need to bring that to the table, whether they get a loan for it, whether they have their own cash they're putting in, or a grant. So now this is sort of the who. Who is this targeted at? This is targeted at middle income households. Lower income, fantastic. We all know that in many of our markets, given the realities on the ground, you often need to be at that sort of more middle income to be able to sustain home ownership right now. So this would allow the home to be sold up to somebody earning up to 140% of their area median income. If it's in distressed areas, if it's in an area that the HFA has picked with its flexibility and it's not distressed, that cap is lower, and they can only be 120% of AMI. And then finally, if it's an owner occupant using it, it's 100%. They need to be at or below the median family income for their area. And then, sort of to Raquel's earlier point, an important part of this program is affordable homes. This is about filling the gap. This is about making it possible for somebody to buy a modest starter home. And so the home price can't exceed 4 times the amount that a typical family in that area is earning. So here's my sort of summary. We got a federal tax credit that is targeted at single family home ownership in distressed areas. We don't have this kind of tool available today, and we know that in many places the economics simply don't work. So this tool would really make a difference in filling the gap and closing the gap in distressed neighborhoods, and making it possible to develop or rehab starter homes, affordable homes, and especially in disinvested areas. And then finally, we have an incredible network of support for this. The National MBA is one of the supporters here, as well. You'll see it just runs the gamut. This reflects how big of a pain point housing supply is right now across the country. We've got everybody from lenders to the American Wood Council to AARP. Folks are really coming together around housing solutions, and this is one of the top areas of agreement. Happy to answer any questions or discuss any of this.
I think this is a very well thought out piece of legislation. That's my 2 cents. It's not a stimulus where it just subsidizes a high purchase price. Although I'm interested in the line item development cost. That seems to drive the whole transaction. How is that policed, that development cost? Because when you think about it, the government really would be, through the credit, the way I understand it, it could have the potential to subsidize the builder's development cost. And if that's more than it needs to be for whatever reason,
Right. So the authority is left to the states to define allowable development costs. So that would
Okay.
really be your HFA that is getting into the,
Mhm.
into the details on what, what percentage developer fee they'll allow, for instance.
Mhm.
Um, I think that one of the reasons that folks have gotten comfortable with this approach is that we do actually see plenty of building going on across the country, but it's at a price that most folks can't afford. And
Right.
so this is a little bit of, let's put a thumb on the scale and direct some resources to incentivize the production of this kind of entry level home, because it's not happening at scale.
Mhm.
And so, but it will be up to the states to design their programs in a way that hopefully simple enough to use, because my goodness, so many of our programs, in an attempt to make sure to avoid abuse, which is important, they become so complicated that nobody can use them. And so the
Mhm.
HFAs, particularly in this moment, will have a fine line to walk. But I think they have been at the table. NCSHA has been a great partner in developing the proposal, and I'm confident they will get the balance right.
Yeah, that makes a lot of sense. Keep it simple. Is there a lobby that's like the Keep It Simple lobby organization out there? We need to do that in New York
Probably, if
anyway.
there's not, somebody needs to, you know, reserve the domain name.
Uh-huh.
Yeah. Well, so what's the current status of this piece of legislation? And
Yeah.
how optimistic are you about it moving forward and being reality?
So we are in an incredible moment of bipartisanship for housing. Um,
Agreed.
I had the opportunity to hear Representatives Flood and Cleaver speak yesterday about their work on a number of proposals in the House. Everybody knows the road to housing, not everybody knows, but those of us who follow housing know that the Senate Banking Committee passed out unanimously 24-0 a comprehensive housing plan. So there's a lot of attention on housing, and this proposal's up there. We have great support from the key housing leaders in both the House and the Senate, and on Dem and Republican side. I think that where we are right now is continuing to build awareness and understanding of how the program works, beginning to, continuing to build out the number of co-sponsors, and beginning to educate leaders. So, to the Senate and House leaders. So Leader Schumer, or
Mhm.
Chuck Schumer, Hakeem Jeffries, um, because at some point, I mean, it seems like the way that things are typically getting done in our Congress right now is a good idea will move and move and move, get as far as it can, but the things that are getting passed are happening in unexpected ways. You think about the tax bill earlier this year. So
Mhm.
having something ready to go with sufficient support and awareness and being able to seize that opportunity is going to be really important.
I would agree with that. Yeah, 100%. So I'm bullish on home reno construction firms at this point. I
Hmm.
think because when you look at it from a historical risk analysis, right? A lot of the homes that are in those target areas, the census tracts, the homes with the blight, they maybe need a full rehab. The risk level in getting involved with that is historically been too high. It's been risk
Mhm.
prohibitive and obviously cost prohibitive now. This is a very well thought out and it expensive nevertheless, but hey, it is what it is, right? The state can't do this type of program. This has to come from the federal government. And to have a proposal in place that actually addresses that value gap and provides a path that's conceptually clean to get to get this home back on the market, back on the tax rolls, off the vacant list, um, in an environment where housing is in high demand, especially lower income or more affordable housing is in a super high demand. First time home buyers, they've been pinched lately.
Mhm.
I think it's the perfect time and a very reasonable solution if it can be funded without blowing up the already bloated budget at the federal level.
Yeah, I mean, and the deck ate one of my slides, but I had one on sort of projected outcomes. And
Mhm.
Mm.
over 10 years, this proposal, if enacted, the estimate is that you would see 500,000 homes either built or rehabbed. And is that a silver bullet? No, but that is a massive dent. And you think about all of the costs associated with these folks who are not getting to build equity at this moment. You even think about the
Mhm.
tax revenue implications of not having those homeowners get, the average home buying age right now is 38 years old. Like,
Mhm.
if we don't figure out this issue, there are also a lot of follow-on consequences,
Oh yeah, family
fiscal
formation,
consequences.
all that's absolutely.
Yeah. So it's
Um,
it's an investment that's worthwhile. I think we would all agree.
well, the ancillary benefits from that are amazing, right? You bring people in and they're living where they work. They're contributing to the local economy.
Mhm.
A new construction or a newly minted house or a renovated house, you fill that up with, you put paint on the walls, you buy furniture, you buy all this. I mean, it's a it's a stimulus
Yeah.
in the sense that it stimulates the economy directly by the need for goods and services, not
That's
just
right,
throwing
Brian.
money
And
at
I
the
think
problem.
that is a piece that's
Mhm.
often in DC. We have to really make that clear because I think a lot of policymakers don't associate single family construction with that economic activity and that job creation.
Mhm.
And so that's a point that we've been trying to make very clear that this is about making sure people can afford to live in your community and
Mhm.
work there, but
Mhm.
also all the construction jobs, the services jobs, all the things that go along with restoring buildings and building new ones.
Gotcha. And the administrators of the program would be the local housing agencies, I believe,
The
right?
state, yep, the state housing
Okay.
finance agency, yep.
Mhm.
And an example of that would be in Troy, could be Trip or NeighborWorks affiliated housing
So it
agencies,
would
things like
the
that.
example in New York would be HCR,
HCR. Okay.
and then but they would be giving out the credits, but they may choose a NeighborWorks, or they could choose, they could choose a local developer, they could choose a bank that is standing up a renovation program for owner occupants.
Hmm.
They could choose just a for-profit construction company that wants to go
Mhm.
into distressed neighborhoods. So they'll have um, pretty good flexibility
Hmm.
with how they stand up the program.
Yeah. And for those that are listening to this valuable piece of forward-looking information, get involved, make connections with these folks.
Mhm.
There's a lot of momentum in this space right now, and things are starting to come together. So stay tuned. That's fantastic. One last question. Let me check the chat real quick. So I have another question. Are there deed restrictions or covenants or things that would impact, that would have to be sorted out for conventional lending that exist within these properties to keep them under the
Mm.
umbrella of affordable
Mhm.
home, affordable units?
There's no requirement that these be deed restricted.
Okay, not like a workforce property or
Mhm.
things,
No,
because
no.
they've
I mean,
gotten creative.
that initial sale,
Hmm.
there is a requirement that can't be, it has to sell to a
Hmm.
moderate income person, and it can't be more than 4 times what somebody in that area is earning.
Got
But
it.
after that initial homeowner is in there, there are
Mhm.
no restrictions on what they sell it for. They do have to
Gotcha.
stay, if they do have to stay for 5 years. If
Hmm.
they sell before, like, there's sort of if they sell prior to 4 years, when they sell, some of those proceeds have to go back to the state housing finance
Was
agency.
a clawback of the credit type provision.
Basically,
Okay,
yeah.
Mhm.
that makes sense. Well, I'm blown away. This is fantastic. I'm so glad we kicked off our Affordable Friday series with you folks. This is very valuable information. And we're going to have this recorded on our YouTube channel. Just search out New York MBA within your YouTube space, and you'll be able to pull this up. Um, Fantastic stuff. So that's all I have on my side of the questions. Any other comments to wrap this up or round it out?
I would just say thank you so much for having us. You now know where to find us.
Yeah, we do.
Eager to chat. If anybody has you know, if you want a creative thought partner as you're standing up a program, if you want more technical details on how we work or the policy
Mm-hmm.
works,
Mhm.
our doors are open.
I love it. I love it. That's great. Raquel, Carlos, Sarah, thank you so much for being with us today. It's been a pleasure having you, and I've personally learned a lot. I hope the audience has also. Um, and just again, check it out on YouTube for those that could not attend. Um, we have another Affordable Friday webinar coming up on October 17th. And we're going to be talking about generational wealth and financial literacy. So don't miss that one. We're going to have our very own Jeff Wilkish, Loan Depot's Regional Vice President for New England, and Lisa Atkins, a CRA loan originator at Arrow Bank, is going to co-host that one. Listen, have a great rest of your Friday. Have a great weekend. And all of you out there, do your best to keep it affordable. All right.